In this video, I'm going to show you how to generate $10,000 a month of rental cash flow. And so let's dive right into it. We're going to talk about how to build that portfolio. We're going to talk about strategies to acquire, manage properties, scale your rental portfolio. And then we're really going to look at real numbers. I'm going to show you some real numbers so that you can see what this actually looks like. Let's go ahead and get started. So let's kick off with really the benefits of real estate. Like, these are very, very obvious, but I think we need to go over them again. We know that people love cash flow. Like, this is why people do it. They think mailbox money. They want to sit at the house and they want to get cash coming into their mailbox. So cash flow is king. And so this is the first benefit of owning rental real estate. Also, you can leverage other people's money. OPM is what we call it. And you can do that with other investors, partners. You can do it with owner financing. There's several different ways you can do this. So you can use that as a tool to build your portfolio. Also, we know that properties appreciate over time and that there's tax benefits to owning rental property. And then ultimately, most of the long-term wealth built in this country is built through real estate. People buy real estate. Over time, it's proven to be a fantastic investment. All right, so let's go into the cash flow formula. Really, we know that cash flow is just a product of the rental income minus all your expenses. So what are your expenses when you own rental property? You have to be careful with this. You need to know, you need to make sure you're counting all of these as expenses. So you have your mortgage payment, obviously, unless you're paying cash. You have your property taxes, your insurance. Now, I would say right here on property taxes, make sure that the property taxes you're calculating in your numbers are non-homestead. Maybe in the area that you're buying in, they may that tax number may change. Here in Jefferson County, where I am, in Birmingham, Alabama, the non-homestead taxes are double what homestead taxes are. So you want to make sure that you understand what the taxes are. Of course, insurance, maintenance. Every rental property is going to have maintenance. Even if you buy something brand new, you may not have maintenance the first 12 months, but more than likely over 24, 36 months, you're going to have maintenance. If you buy an older house, even if it's rehabbed, understand residents are going to require maintenance on these properties. So don't skimp out on your maintenance numbers. Property management, if you're buying out of state, this is a must. You must use property management. Even if you're buying in state, the way I want you to think about property management is, what is your time best suited doing? Is your time, is it worth you managing property, showing property, running the screening process to find the best residents? Or is your time better spent searching for better deals, more deals? Or you may already have a W-2 that you're working in, and so you need to be working on that job. That's why a lot of people even locally choose property management. Last thing I would say you need to account for is vacancy. Vacancy when you buy it and rehab it and put it on the market, and then probably vacancy once somebody moves out. I would say the average resident lives in a property 2.5, 3.5 years, somewhere between there, maybe 3 years, and then they move out. Calculate vacancy in your numbers. You can't ignore that. All right. So cash flow is the rental income minus all of these expenses. And so if you want access to a calculator that we have, it's free. You can access this cash flow calculator. It'll take into account all of these things and your financing, insurance, taxes, all these things, and spit you out the true cash flow numbers for you. So that's the cash flow formula. Now, setting your goal, your $10,000 a month goal. This is really, really important. I'm always thinking long-term. What are you trying to achieve in 10 years and 5 years, and then we break it down into 1 year. And then what I do with some guys that I meet with on a regular basis, we break it down into quarterly. What needs to happen this quarter to move me towards that target? And as a matter of fact, even here at Evernest, we do the very same thing. We run the EOS model, but it's all about setting targets and then backing your way into it. So if you have a $10,000 a month goal, you need to back into it. But you have to be thinking long term. This is not going to happen overnight. I have really seen investors get in trouble trying to jump to $10,000 a month right off the bat. So where I've seen people get in trouble is I've seen them buy big portfolios of rental houses in, say, C-class, D-class neighborhoods. And what that means, C-class is like working class neighborhood. They're out, just great, solid neighborhoods. They're not high-end neighborhoods. They're middle of the road. And then D-class is very dangerous because, there's potential for more cash flow, but there's higher crime in these areas. The schools are probably not as good. And it's just harder to evaluate and find great residents to live in your properties long term. So, you need to be thinking long term. Don't shortcut. Don't try to buy a portfolio and just try to skip to $10,000 a month. I think it's better starting off small, slow at a time. And then after you have a few under your belt, if you want to buy 2 or 3, you want to move to duplexes, quads, I think that's okay as well. You want to aim for cash flow. We always say if it's not at least $100 a month cash flow for that property, you shouldn't buy it. But you really probably want to aim for around $150 to $350 per door. So if you're buying a duplex, you would want $200 to $300 per door. That's, I think, very achievable even in today's market. And then, so you have this cash flow of $250 a month. If you wanted to get to 10,000 and you were just kind of sticking around 250, then that's going to equal 40 properties. Now, don't let that scare you. Remember, we got to go back up here. We're thinking long term. We're not thinking, how can I do this in 1 year? Now, you may want to quit your job in 1 year, but don't do it just yet. Take your time. We like to say this is a get rich slow business, not a get rich fast. No matter what influencers want to make you think it is online, it's not true. You have to take it slow and you have to build up over time. So this is what we would say, this is how you get to $10,000 a month. So you can do this with what's known as the BRRRR method, which is buy, rehab, rent, refinance, and then repeat. So you're buying an undervalued property. Now, this is what I'm going to tell you. This is going to be much, much more difficult if you're buying turnkey properties. If you're buying properties at retail numbers, you're going to have to do some work to find some undervalued properties, but they are out there. As a matter of fact, over the past several years, we've seen institutional investors slow down their buying, which you have wholesalers who are trying to find other avenues to sell these properties. This gives the local investor, or this gives the investor, this kind of what we would call mom and pop investor, the one who's buying 1 or 2 properties at a time, gives you a great advantage. There's probably more supply for these undervalued properties out there right now. Then you're going to rehab. So you're going to add value through repairs, right? You're going to buy it at X. You're going to put a certain amount of money in it, and your valuation, your ARV, your after repair value should be much higher than what you have in the property. That's the beauty of buying undervalued properties. Then you're going to rent it. Got to know your rental numbers. We always encourage people to reach out to us if you're looking for rental numbers in a specific area, especially ones that obviously we are managing properties in. We have boots on the ground. We will tell you exactly how much this rental property should bring in. We're not going to sugarcoat the numbers. We're not going to tell you, hey, $2,000 a month, and then come back and say, oh, we could only get $1,500. We want to be as accurate as possible on the front end, because for us, it's all about setting expectations and helping you buy the right property. Then after you get it rented and it's cash flowing, you can refinance and you pull money out of that property, and then you can use it to buy more properties or put down for more properties. I'm going to show you an example here in just a little bit. But first, what we want to do is we want to talk about how you can do this if you don't have a lot of money. I think you can do this using other people's money. The way that I've done it before, I started out with partners. My partners had a lot of money and no time. I had no money and a lot of time, and it was a perfect match. And so I was willing to do all the grunt work. I was willing to go out and look at properties. I was willing to make offers, close on them if they would let me use their money. And so what we really did was the three of us went to a bank and we got a line of credit, and we used that line of credit to buy properties. I couldn't have done it without those partnerships. And so this was perfect for me. I wasn't coming out of pocket a lot of money. It was using the bank. Seller financing is another way we've seen it, especially for distressed property. Maybe a landlord that's had a really bad go of it and they're ready to sell. Typically there's something going on in somebody's life, maybe some type of pain where they're willing to sell at a discount. They're just ready to move on, and that's okay. Because when you come in and buy something and when somebody's in a bit of a trouble, you're actually doing them a favor. You're doing this, it's a great service. So what I've seen also work well is with seller financing. You come and say, hey, I'm willing to buy this property, but I would like for you to hold a note and I'll just pay you every single month. This is what I'm going to do. I'm going to fix it up and I'm going to rent it. And a lot of people will do this because the worst that can happen is they get that property back, rehabbed, and rented. And then lastly is you've got private or hard money lenders. I've got a buddy who does hard money lending. He has $100,000 in an account, and he just lets this one investor draw off that all he wants, and he pays him a percentage. Hard money lending percentages are higher than what you normally would get at a bank, but it's quick. They don't base it on your credit worthiness per se. They really base it on the property value. They base it on the investment. They're going to be experts at looking at these deals and saying, is this worth our money or not? So here are three ways you can do this relatively easy if you want to bad enough. At the end of the day, this is all about desire. Do you really want to do it? And if you do, you can make it happen. There's thousands upon thousands of investors who have done this just like this. Where there is a will, there is a way. You just may have to get creative. So let's talk about the best markets for this. I would say you're not going to do this in a Nashville. You're not going to do this in a Denver. You're not going to do this in Los Angeles or New York or some other very expensive neighborhood. You are going to be looking for higher cash flow markets. We like to call these tertiary markets, which means they're kind of secondary markets. So to give you an example, we're in cities like Columbus, Ohio, Cleveland, Ohio, Birmingham, Alabama, Chattanooga, Tennessee, Jackson, Mississippi, Little Rock, Arkansas. There are some incredible markets that you can still find properties that cash flow. As a matter of fact, I was talking with our agent in Jackson, Mississippi not too long ago. He was telling me he's still finding deals that fit the 1% rule. And the 1% rule is what you buy it for. So you buy it for $100,000, it will rent for $1,000. That's what the 1% rule is. And with interest rates the way they've been and property values shooting up in a lot of markets, the 1% rule has gone away. But he's been telling me, hey, we're finding these still in Jackson, Mississippi. Great opportunity. So we are big proponents of high cash flow markets with affordable property prices. Now, what you have to realize is that in these tertiary markets in the Midwest and the Southeast, you're not going to have massive appreciation like you would in maybe in a Denver or what Denver's experienced over the past 10 years. You're not going to have that. So you have to be okay with rental appreciation and then some modest appreciation on the property as well. But if you're trying to create $10,000 of cash flow, then that's okay. So I would say the best ones are C-class neighborhoods. I've mentioned this before. These are working class neighborhoods. These are neighborhoods that, just the people are out working. They're middle class. It's a perfect neighborhood for investors to find some undervalued properties, have some equity right away, and then rent them because these are highly sought after rental areas. You can buy in A-class neighborhoods and B-class neighborhoods, but you're not going to have a lot of cash flow. Usually in C-class and D-class. I'm going to steer you away from D-class unless you're a very experienced rental property investor. And then what to look for? Obviously, you're looking for reasonable rental prices, strong rental demand, opportunity for value add. So what we look at is we go into these markets and we're meeting with our agents who are investor-friendly agents. And we're talking about Hey, where are you seeing high demand for rentals? Where are you seeing areas maybe coming back a little bit? Maybe they've been a little bit depressed. Maybe they're coming back. And so a great investor-friendly agent knows these areas. They're dealing with other investors, and these other investors are buying in these areas. So you can find these if you're talking to the right people. And then obviously this is going to have maximum cash flow, right? The working class neighborhoods, you want to minimize vacancy, and you want to minimize your maintenance costs if at all possible. And the way you do that is to do a really good rehab. You can, if you're in the market, you can consider self-management. If you're living in that market and you have the time, you have the expertise. Otherwise, it's not going to be worth saving the 10% of rent each month that it's going to cost you to hire a rental property manager. And I would say a property manager is going to add more value, not just managing property, finding residents, collecting rent. They should add a lot of value from an investor standpoint because they are investors themselves, or they have worked with hundreds and hundreds of real estate investors locally. That's the big value these people bring. You want to add value through upgrades. The thing you want to be careful of in these C-class neighborhoods is not to go overboard. You don't have to put granite in every place. You don't have to rip out cabinets and put in brand new cabinets and marble and all this stuff. Just do a great rehab. Put in things that are nice, but not too nice. Like, you have to know the market. You're not going to squeeze another $200 a month out of people in a C-class area by putting, marble countertops. They don't care. So just know what you're doing when it comes to upgrades. And then obviously, if you can find some small multifamily, I think that's great. Just be careful. I would only suggest this if you bought and owned rental property before. Don't just go out and buy don't start off with a 14-unit rental property. This could be a disaster. I myself have had I've got a story around a multifamily that me and my partners bought that we didn't do enough due diligence on, and it wasn't a great experience for us. And we were local investors and had been doing it for a while. So you need to really know what you're doing before you buy bigger than a quad. All right. And then here's an example of a tertiary market where you could find something. I think this is pretty reasonable here. So let's just say you find a distressed property. You're able to put it under contract, buy it for $75,000. You've got $25,000 worth of repairs in it, and then you rent it for $1,200. Now, this is around the 1% rule. Really, the way you do this is not through turnkey properties, which is really you're buying it at retail. You do this through buying distressed properties, then adding value by rehabbing it and renting it. This is how you do it. I have done this so many different times, and $25,000 is kind of the norm of repairs when you find a distressed property. 25 is about average, I would say. Let's say the property then appreciates to 150, so the ARV is 150, right? You've got 100,000 in it. You've rented it for 1,200, and then you're able to get an appraisal for 150. Then what you can do is you can get 80%. You can pull out 80% loan to value, which would be 120,000. So then you go and you refinance it, cash out, refinance at 120. That means you're going to walk away with $20,000 to then go and put that down towards another rental property. This is how a lot of people do it. I would tell you, obviously, the market makes a difference. If you're watching this today, the day that I'm recording it, well, then the market may look different when somebody's watching it in 2 years or 3 years. Overall, this is generally a principle that works, but what I would say is just be very, very careful. Don't over leverage yourself and get so leveraged and then all of a sudden something happens and you need that cash for something else, an emergency in your life. Just be very, very careful. Use debt wisely is what we always tell people. Again, here we're going to manage risk. Managing risk talks about we want to plan for vacancies and maintenance. We don't want to get too rosy with our numbers. We want to be very realistic. Build an emergency fund for CapEx. So you are going to have roofs. You're going to have heating and air. You're going to have water heaters. These are big time expenses. You might have to have the whole outside of the property painted if it's not brick. Be careful. Then again, we've already talked about property management. As you're scaling, as you're building, not just one property, but 2 and 3 and 4 and 5 and up to 10 to 20 to 30, then I would say use an expert, use a property manager. They're going to be an incredibly valuable part of the team. As a matter of fact, we actually feed our owners deals because we work with so many different investors. We're actually able to feed other investors deals that people are ready to trade a house, right? They're ready to sell at different times for different reasons. And then long-term scaling strategy. I'm a big believer that this is long-term. Again, we've already said, use your profits to reinvest. Don't use the profits to go and just rip it out and take and go buy a Lamborghini. You want to use the profits wisely, reinvest to buy more properties. Again, 28 to 40 properties, depending on the cash flow for each property. You can accelerate this a little bit with multifamily, but just be very, very careful. Be conservative in your numbers. And then, you can, what I've seen a lot of people do is diversify property types. A lot of times people will build a single family rental portfolio and then they'll sell the entire portfolio after a while, and they'll 1031 exchange that into multifamily or commercial. I've seen this happen a number of times, and for them, it works. So this may absolutely work for you. So this is how a lot of people build wealth. This is how people get to $10,000 a month in passive income. Now, I use the word passive income loosely because there's still a lot of work that goes into it. You're going to have to do a lot of work. Your team's going to have to do a lot of work. But you can use other people's money, the BRRRR method. There's all kinds of ways that you can do to just accumulate one property at a time. Take your time. $10,000 a month, this is the key, is achievable with a steady and disciplined approach. Are you disciplined? Again, this is not a get-rich-quick type of process. This is a slowly over time. You want to at least have probably a 5 to 10 year time horizon that you're thinking about. And so my advice to you is start small, scale little by little. Once you get one under your belt and understand the process and how it goes, and if it's working for you or not working for you, then you can move on to the next one and just focus on long-term success. You're going to have struggles along the way, but we love Ray Dalio, and Ray Dalio says pain plus reflection equals progress. So as long as you're reflecting and growing from the short-term setbacks that you're having, then overall, over a long period of time, you're going to become a better investor, wiser investor, and you'll build long-term wealth. So if you've enjoyed this video, we'd encourage you, visit our website. If you want to talk to an investor-friendly agent, we have plenty of them all around the country. Reach out to us. You can get the calculator down below. You can check us out down below and subscribe to our channel, because we're going to keep coming back and providing you with investor-friendly videos just like this one.